Hello everyone. Let's tackle a very interesting question which can be asked in the FRM or the CFA exam. So a trader writes a European put option with a strike price of $150 on a stock trading at $110. The option has 3 months to expiration. Implied volatility is also given 25%, risk-free rate is given as 5%. What is the credit exposure of the trader after receiving the premium upfront? So trader writes this put option and we are being asked that what is the credit exposure after receiving the premium upfront? So at first glance, you'll see all these numbers, 153, 5% and 110, 25%. You might think, do I need to calculate something over here? But this is actually more of a conceptual question. You don't have to crunch the numbers over here. It's all about understanding who faces the credit exposure in a put option transaction, or for that matter, in any option transaction as far as the seller is concerned, because the same thing will apply to the seller of a call option also. Okay. So the correct answer over here is $0. Why $0? So to understand that, we need to understand what is the seller's role over here. Okay, what is the seller's role over here? So seller, of course, or the trader in this case. So when the seller is writing the put option, they are receiving the premium upfront. Okay, so it means that the seller is not having to rely on the buyer for any payments in the future down the line. Okay, so seller does not rely on the buyer for any future payment. This is very important. Seller does not rely on the buyer for any future payments whatsoever. Okay. So seller does have an obligation. If the buyer exercises the option, the seller has to buy the stock at the strike price. Okay. Or let's say pay cash if cash settlement is an option. But this obligation is not credit exposure. Why? Because there is no risk of financial loss if the buyer defaults. Okay, try and understand the point. There is no risk of financial loss if the buyer defaults. If buyer defaults. Okay. Now let us understand the buyer's role over here. So let's understand the buyer's role. Okay. So what is the buyer's role? Now the buyer is actually facing the credit exposure because they are the one who are relying on the seller. So the buyer is actually the one who relies on the seller. Okay, if the option ends in the money and the seller does not fulfill their obligation, maybe they default, let's say, completely, then the buyer risks losing the value of the option, the intrinsic value of the option at least. Okay, so the risk is on the buyer's side, not on the seller's side. Okay, so the buyer is actually facing the risk, not the seller. So what is the key takeaway over here? Okay, credit exposure, as far as credit exposure is concerned, this credit exposure, it will arise when one party risks any kind of financial loss in case of default by the other party. Okay, so in this case, this trader or the seller has no such exposure because they have already been paid, right? The exposure lies with the buyer, because the buyer is the one who faces the risk, and hence the exposure is actually lying with the buyer, who relies on the seller to fulfill the contract. Okay, so even with all these numbers in the question, the concept is actually what really matters. Okay, the trader's credit exposure is 0 because they've already been paid upfront, no calculations required, just a solid understanding of who faces the risk in these transactions. Got it? So focus on the roles. Okay, focus on the roles, not the numbers, and these questions will feel much easier. Okay, fine. Thank you for watching, and I hope this will help you in clearing any concepts with respect to credit exposure, particularly in options trading. Thank you so much. Bye.